Introduction to this portion of the course. Business in today's real estate market. In today's real estate market, every professional entering the industry must understand how real estate value is created, measured, and interpreted. In earlier chapters, you explored how property rights, ownership, and contract structures shape the transfer of real estate. Those foundational skills now connect directly to a broader understanding of value. As a real estate salesperson, whether you are helping a seller price their home or guiding a buyer through an offer strategy, your knowledge of real estate value becomes the backbone of your professional expertise. This section introduces how real estate value emerges from economic forces, investor goals, property characteristics, and community conditions. You will learn about the major types of value used by appraisers, investors, taxing authorities, and lenders. You will also see how principles such as supply and demand, contribution, substitution, and anticipation influence the price a property can command in the market. Real estate is not static. It moves in cycles, responds to demand, and behaves according to predictable patterns rooted in economics, utility, and consumer expectations. Understanding these principles allows you to speak confidently to clients about pricing, investment decisions, taxation, and long-term planning. This portion of the course builds upon your earlier learning objectives by linking business activities, professional specialties, and property type specializations to the concept of market value. As you continue developing your national or general salesperson knowledge, you will see how agents, appraisers, developers, investors, and lenders all rely on these principles to guide decisions in an increasingly complex marketplace. Real estate value. Real estate value represents the present monetary worth of the benefits associated with owning real property. Those benefits typically fall into four major categories: income, appreciation, use, and tax advantages. When the owner leases space or rights, such as air, surface, or subsurface rights, the resulting income contributes directly to value because investors will pay for predictable income streams. Appreciation occurs when a parcel increases in value over time, often due to rising demand or market momentum. Use also shapes value because residential, commercial, industrial, agricultural, and recreational properties carry different benefits depending on how well they meet community needs. Tax benefits, such as treatment of capital gains, depreciation, or deductions, can make ownership financially attractive and influence the price an investor is willing to pay. These factors work together to form the value that buyers and sellers negotiate. An agent's skill lies in recognizing how these components interact and applying them to real-world transactions. Understanding real estate value in practice. Every parcel of real estate carries a value that buyers are likely willing to pay. Your responsibility is to help sellers determine a price aligned with market conditions and to help buyers understand what constitutes a fair and competitive offer. To do this, you must understand how value is determined across several different measures. Market value. Market value is the most commonly used valuation measure. It reflects what buyers in the current market are willing to pay based on recent sales of similar homes. When you prepare a listing, you analyze comparable sales and adjust for differences, such as lot size, number of bedrooms, location, or upgrades. For example, if your listing has a remodeled kitchen and comparable homes do not, your home may command a higher value. Conversely, if market activity has slowed, even upgraded homes may see pressure to price more competitively. Market value emerges from one powerful idea: a property is worth what the market will bear. Investment value. Investment value reflects what a specific investor believes a property is worth based on their personal goals, risk tolerance, and intended use. For instance, suppose an investor named Tim is interested in a commercial building located in a high-traffic area. He sees the potential to add 4 additional office units and increase income. The property holds more value for him than for an investor who only purchases apartment complexes. As a result, Tim may pay more for this property because he perceives greater opportunities for growth and return. Assessed value. Assessed value is the value placed on a property by a taxing authority to calculate property taxes. It is often a percentage of market value. If a home has a market value of $200,000 and the county assesses taxes at 40%, the assessed value is $80,000. If the tax rate is 2.5%, the annual taxes equal $2,000. Buyers and owners should understand assessed value because it affects long-term affordability and investment decisions. Value in use. Value in use represents the return the owner expects based on how the property performs financially. If Tim evaluates his commercial property by comparing acquisition costs to expected rental income, he is using value in use. Typically, this value is lower than market value because it focuses strictly on performance rather than market demand. Economic foundations of value. Real estate value is shaped by several key economic principles that guide appraisers, investors, and market participants. Supply and demand. Supply refers to the number of available properties, while demand reflects the number of buyers who want them. When demand exceeds supply, scarcity drives prices upward. When supply exceeds demand, values decline. In a balanced market, prices remain stable. Contribution. Contribution examines how much a particular improvement adds to the overall property value. If a new bathroom increases the home's value by $15,000, its contribution is $15,000. Even if the owner spent more or less on construction, continuous improvements eventually reach diminishing marginal returns, where cost exceeds added value. Utility refers to how useful a property is in the marketplace. A piece of wetlands may serve an ecological function, but offer limited utility if it cannot be developed or used profitably. Properties with high utility attract more buyers and generate stronger demand. Transferability. Buyers prefer real estate that can be easily transferred with clear title. Encumbrances, legal disputes, or unclear ownership reduce value because they make investment more difficult or risky. Anticipation. Buyers consider future benefits when purchasing. The expectation of rental income, redevelopment opportunities, or improved neighborhood conditions directly affects the price a buyer is willing to pay. Substitution. A buyer will not pay more for a property than the cost of another, equally desirable substitute. If 3 nearly identical homes are for sale, the buyer will choose the most affordable option. This principle guides appraisers in selecting comparable sales. Change markets. Change continually as neighborhoods evolve, new developments emerge, or economic shifts influence buyer preferences. A new shopping center may increase nearby home values, while deteriorating infrastructure may weaken them. Highest and best use. A property achieves maximum value when used for the purpose that yields the highest return, provided that use is legally permissible, physically possible, financially feasible, and maximally productive. For example, a home located in an area transitioning to retail development may hold greater value as a commercial building rather than a residence. Conformity properties achieve optimal value when they blend with surrounding uses. A small home in a neighborhood of larger homes may benefit from expansion, while a luxury home surrounded by modest homes may experience lower value due to regression. Progression and regression. A property surrounded by higher value homes tends to increase in value through progression, while a home surrounded by lower value homes may experience regression. Assemblage and plottage. Assemblage occurs when adjacent parcels are combined into one larger property. If the combined parcel is worth more than the individual parcels, the added value is called plottage. This principle is often used in commercial development and redevelopment projects. Subdivision, the opposite of assemblage, Subdivision divides a large parcel into smaller lots. A single acre worth $50,000 may be subdivided into 4 lots worth $30,000 each, dramatically increasing total value. Types of real estate value. Different appraisal situations require different types of value. These include market, reproduction, replacement, salvage, plottage, assessed, condemned, depreciated, reversionary, appraised, rental, leasehold, insured, book, and mortgage values. Each serves a unique purpose in evaluating the worth of a property for taxation, insurance, investment, or lending. Review summary. In this chapter, you learned that real estate value is based on benefits such as income, use, appreciation, and tax advantages. You explored how market value reflects what buyers are willing to pay, while investment value depends on a specific investor's goals. You also reviewed assessed value for tax purposes and value in use for return-based decisions. You then examined essential economic principles, including supply and demand, contribution, transferability, substitution, highest and best use, conformity, progression and regression, assemblage, subdivision, and anticipation. Finally, you reviewed the many specialized types of value used in appraisal: taxation, insurance, and lending. Discussion. Why is highest and best use important in determining value? Answer. Because it identifies the use that produces the maximum return, ensuring the property is valued at its most productive, legal, and feasible use. How does substitution influence a buyer's behavior? Answer. Buyers will not pay more for a property if an equally desirable substitute is available at a lower price. Why might investment value differ from market value? Answer. Because investment value reflects a specific investor's goals and opportunities, while market value reflects general market conditions and buyer behavior. How does progression affect home values in mixed-value neighborhoods? Answer. Lower valued homes surrounded by higher valued homes tend to rise in value due to the surrounding market influence. Closing remarks. Real estate value is at the heart of every real estate transaction. As you progress in your career, your ability to understand and explain value will distinguish you as a trusted professional. The concepts introduced in this chapter will support your work in pricing, negotiation, investment guidance, and client education. Mastery of value principles builds confidence, sharpens analytical skills, and strengthens your effectiveness in an increasingly competitive real estate marketplace.